Bismillahirrahmanirrahim. Hope you all are fine. As we discussed in the previous classes about the role of financial management, and then we discussed the very important chapter, time value of money, and after that we discussed the capital budgeting techniques. Now we have to discuss the financial statement analysis. As we know that financial statement shows the financial strength and financial position of a business, and it also shows the snapshot of a business. So how to analyze these financial statements in a meaningful way, so we have to discuss all in this chapter. So in this chapter, we will discuss financial statements, a possible framework for analysis, ratio analysis, trend analysis, common size, and index analysis. Now, we have some external users. You know that external user, who is external user of financial position, financial statements, who can use it. Now we have different users like internal users as well as external users. Internal users consist of management, employees, and the workers inside the organization, while external users include trade creditors, bondholders, and shareholders. And also you can consider government as an external user because they also have stakes in your organization information. So let's come to the trade creditors. Trade creditors always focus on the liquidity of a firm because you know that it's a current liability, so they always focus on the current assets, right? How many current assets a firm has, and for one asset, for one current liability, how many current assets a firm has. So the focus of trade creditors is always on liquidity. Then come to the bondholders. They always focus on long-term cash flow because bonds have a long-term debt, so the focus is on always on long-term cash flow. And shareholders is focusing on the profitability, which is known as dividend, and the long-term health of a firm, because if a firm can survive for long run, it means that they will pay good installments of dividend. So definitely a man is rational. Definitely a shareholder always focus on the profitability. Okay, now the internal users plan who plans different financial things, focus on assessing the current financial position and evaluating potential firm opportunities. Okay, controlling, focus on return on investment, that how much money is returned with different assets, with the use of different assets. And let's suppose you are purchasing a machine, so you must have a return in mind that after a year or after a specific time period, this machine will earn a specific amount for me, so for your business. And so you have to check and you have to control the efficiency, the production of an asset to get the desired rate of interest, the rate on investment. And focus on understanding how suppliers of funds analyze the firm. Okay, so we have two primary financial statements. The one is balance sheet and the other is income statement. Balance sheet actually shows the financial position of a business, and it is also known as a snapshot of a business. Like we saw different pictures, and we see different pictures, and sometimes we see a scenery, so we can say that, oh, it's very beautiful, and we can check our pictures for taking different pictures. We see that, so it shows the overall position of a scenario, of a person. Okay, so similarly balance sheet shows the financial position of a business. Why we call it as a snapshot, a picture? Because with one click, balance sheet is a paper of is a statement of one sheet, is a statement of one paper. So in a single paper we know the soundness of a business. we know the resources of a business, we know the liabilities of a business. So that's why it is known as a snapshot of a business. It clears each and every aspect of a business. That's why we call it as a snapshot of a business. Okay. And now a summary of financial statement position on a given date that shows total assets are equal to total liabilities plus owner's equity. So you know that the balance sheet is working on the accounting equation, which is known as total asset divided is equal to total liabilities plus owner's equity. Now come to the income statement. Income statement shows the financial performance, or simply it shows the income or loss, or it shows the revenue and expenses over a specific time period, and it shows the net income or net loss incurred by a business. Okay, so income statement show the financial performance, and financial can be measured by the profitability or loss. If there is profit, it means that firm is profitable, it is the performance is good. If it shows you the loss, so it means that the firm is going to the performance of a firm is not good. Okay, and we have all financial statements, which are the first one is balance sheet, the second one is income statement, the third one is statement of retained earnings, then cash flow and working note. So we have complete 5 financial statements, but the primary financial statements are balance sheet and income statement. Okay. Okay, so it's balance sheet asset side of basket wonders. As you know that it's on 31st December 2003. All figures are in thousands. So cash and cash equivalents like bank, like checks, etc. So these are $90,000. Account receivables are $394,000. Inventories, prepaid expenses, accumulated tax prepay, and at the end you have total current asset, you have total net fixed assets, and other assets. Okay, so the total assets is 2,000 to 169,000. Okay, and now what are different questions? The first one, how the firm stands on specific date. On this date, on this date, what is the position of the firm, what BW owned, what they have, the amounts owed by customers. Okay, how many account receivables we have, the future expenses items already paid. It's talking about prepaid expenses, cash likely convertible cash within 1 year. So it's talking about current assets. Okay, and number F point is original amount paid. So the fixed asset is the amount which is originally we have paid. Okay, and we have no recovery of this. We have to pay a depreciation on this. Like in the next, accumulated deductions for wear and tear. As you know that depreciation is an amount, a gradual decrease in the value of asset due to wear and tear. Okay, now the second side of the balance sheet, which is also known as liability side. So in liability side we have current liabilities as well as total equities, and the long term debt. So it also shows you the notes, assets is equal to liabilities plus owner's equity. It's our accounting equation. As you know that total liabilities plus owner's equity is equal to 2,169. As in the previous slide, you know the amount of total asset is also the similar amount. Then we have what BW owed and on ownership position, owed to supplier for goods and services, unpaid wages and salaries, and the portion of D, debt payable within a year. It is known as short-term debt, and debts payable more than a year, it is known as long-term debt. And then original investment, that how much amount you already invested, which is known as your common stock. Okay, and then earnings reinvested, the amount you have earned but you have not spent for your personal use, so you reinvested in the business. Okay, and now we have income statement. So it's net sales, cost of goods sold, So we minus net sale from the cost of goods sold, so we will get gross profit. Then we will minus selling and general administrative expenses. So after that, so after deducting sales and general administrative expenses, which is 402, we find out EBIT. What is EBIT? So let me clear you that what is EBIT. It is actually, I will write here, earnings before interest and tax. So EBIT full form is earning before interest and tax. Okay. So EBIT is 410. Then we will deduct interest from EBIT. So it will we will find out EBT. EBT means earning before tax, because we have deducted interest, and after uh, deducting tax, so we will find out earning after tax. What is this? Earning after tax. And when we reduce the cash dividends, so increase in retained earning, it means that it is the value of net income. This is the $53, $53,000 is the value of net income, which will show you the financial performance of a business. Okay, so all other things are written here that measure profitability over a time period. What is this? It will show you the profitability. Then receivables or receivable from customers, then sales, commission, advertisement, office salaries, etc. And operating income. What is this? EBIT is your operating income. Okay. Then cost of borrowed funds. Cost of borrowed funds is known as interest expense. Okay, borrowed funds, we have to pay interest on loans. Okay, long-term loans, which is also known as borrowed funds. Then we have taxable income. The taxable income is this, earning before tax, and we apply the tax rate, and after that we will get earning after tax. Okay, which is also known as the amount earned for shareholders. Okay, then so it's a simple sketch of income statement, and before that we discuss about simple sketch of balance sheet, both side of balance sheet. Now the next we have to discuss the framework of financial analysis. We have trend, seasonal components. What is this analysis of funds need to a firm? We can find out with the trends and seasonal components that what is the trend. Trend means the flow of trends of funds in an organization. Okay, so there is a upward trend. If uh, the graph is going down, so it means that there is a downward trend. Okay, so we have to find out these trends. So how much funding will be required in the future? The trend is going upward, so we need more investment to get opportunities. And is there a seasonal component? Now I have to show you what is seasonal component. Let's suppose you started your business and it's going on the peak, and then become down for some months, and then it there is a volatility, there is increase, and then it become decrease to a specific point, and then it is increase. So there are some seasonal trends in your business, that sometimes it's gone up and sometimes it's gone down. Seasonal businesses, seasonal business like beverages, Pepsi Cola and Coca Cola are seasonal businesses. The trend of these businesses are high in summers, while in winters the sales and all such things are low. So these are seasonal businesses. Okay. So analytical tool use sources and uses statement of cash flow, cash budgets. These are different analytical tools which are used to find out the framework for financial analysis. And the second one is analysis of financial condition and profitability of the firm. It's a health of a firm with the help of financial ratios and individually over the time in the combination and in comparison. Okay, so we will perform financial ratio in these all contexts. Now, what is the risk? Each and every business involved risk. There are two types of of risk. The first one is business risk, and it is related to inherent risk. Risk is also known as inherent, which is from virasat. In Urdu, we can call it as virasat. So the risk in by default involved in a business is known as inherent. Okay, in simple I will write is as by default risk. Okay, so the risk which is by default involved in an organization in a business is known as business risk in the form operation of like volatility of sales. Volatility of sales means the ups and downs of sales, volatility in cost. Sometimes your cost is at this level, then it come to down. Sometimes your cost increase due to abnormalities, so there are some volatilities in your cost as well. And proximity to break-even point. Sometimes you achieve your break-even, but you know that break-even is equal to no profit no loss. So sometimes you achieve your break-even, but sometimes it disturbs. So these are different examples of business risk. Now, number 4, determining the financing needs of the firm. Due to these three analysis, we determine the financing need by a firm. A financial manager must consider all three jointly when determining the financing needs of a firm. Let's suppose you are a financial manager of a business, so you must go for all of them. Then you will determine that what are the financing needs of a firm, that what your business actually needs. Okay, so negotiation with the suppliers of capital, and it's all about the framework of financial analysis. Now we have another topic, which is the use of financial ratios. A financial ratio is an index. Let's suppose we have PSX, Pakistan Stock Exchange 100 index. Okay, you have studied it in statistics, that what it index, which tells you, which compares a thing from another thing. Okay, let's suppose you comparing A and B, so you must have an index, you must have a measurement rate. Okay, so financial ratio is an index that relates to accounting numbers, and it's obtained by dividing one number by another. Okay, types of comparisons: internal comparison and external comparison. In financial ratios, we have two types of comparisons. Okay, one is within the industry and one is outside the industry. Now, external comparison and sources of industry ratios. It involves comparing the ratio of one firm with those of similar firms or with industry average. Similarity is important, as one should compare apples to apples. Let's suppose you are selling apples, so you have to compare yourself with the seller of apple. You can't compare yourself with a shoemaker, with or a biryani seller. Okay, so definitely you have to compare yourself within your industry, within the similar industry. Okay, let's suppose there are 14 apple distributors, so you have to compare yourself with these 14 apple sellers. Okay, not with any other commodity.